Welcome to today's lesson on internal rate of return. Commonly abbreviated as IRR, this is a fundamental concept in corporate finance that measures the annualized return on an investment. IRR is particularly useful because it accounts for the timing of cash flows, making it a time-adjusted measure of returns. Throughout this presentation, you'll learn how to calculate and interpret IRR, understand when to use it, and recognize its limitations in investment decision-making. Internal rate of return is defined as the discount rate that makes the net present value, or NPV, of all cash flows from an investment equal to zero. In simpler terms, it's the break-even rate of return for a project. IRR is always expressed as an annual percentage, making it easy to compare with other investment opportunities or required rates of return. One of its key strengths is that it fully accounts for the timing of cash flows, recognizing that money received today is worth more than the same amount received in the future. The mathematical formula for IRR sets the net present value equal to zero. The formula is NPV equals the sum of cash flow at time t divided by 1 plus IRR raised to the power of t, and this sum equals zero. Let's break down the components. CF sub t represents the cash flow at any given time period t, the variable t represents the specific time period. IRR is the internal rate of return we're solving for. And NPV is the net present value, which must equal zero. This formula requires iterative calculations or financial software to solve, as there's no simple algebraic solution. Let's work through a practical example to see how IRR works in action. Imagine you're considering an investment that requires an initial outlay of $10,000. In return, this investment will generate $3,000 in cash flow at the end of each year for 5 consecutive years. The cash flow structure looks like this. At year 0, you have a negative cash flow of $10,000, representing your initial investment. Then, from year 1 through year 5, you receive a positive cash flow of $3,000 each year. The question is, what rate of return does this investment actually provide? To find the IRR, we set up the equation where 0 equals negative 10,000 plus 3,000 divided by 1 plus IRR to the power of 1, plus 3,000 divided by 1 plus IRR squared, plus 3,000 divided by 1 plus IRR cubed, plus 3,000 divided by 1 plus IRR to the 4th power, plus 3,000 divided by 1 plus IRR to the 5th power. When we solve this equation using a financial calculator or spreadsheet software, we find that the IRR is approximately 15.24%. This means the investment generates an annualized return of about 15%. Once you've calculated the IRR, how do you use it to make investment decisions? The decision rule is straightforward. You should accept a project if its IRR is greater than your required rate of return. The required rate of return is also called the hurdle rate or cost of capital. Conversely, you should reject a project if its IRR is less than your required rate of return. For example, if your company requires a minimum return of 12%, and a project has an IRR of 15.24%, you would accept the project because it exceeds your threshold. IRR has several important advantages that make it popular among finance professionals. First, it properly accounts for the time value of money, recognizing that cash flows at different times have different values. Second, it's easy to understand and communicate because it's expressed as a simple percentage, making it intuitive for decision makers. Third, IRR considers all cash flows throughout the entire life of the project, not just initial or final amounts. Fourth, it's particularly useful when comparing projects of different sizes or scales, since percentages are naturally standardized measures. Despite its advantages, IRR has some important limitations you need to be aware of. First, when cash flows change direction multiple times, the equation can produce multiple IRR values, making interpretation difficult or impossible. Second, IRR assumes that all intermediate cash flows are reinvested at the IRR rate itself, which may be unrealistic in practice. Third, IRR ignores the absolute scale of a project. So a small project with a high IRR might be ranked above a large project with a lower, but still attractive IRR finally. When comparing mutually exclusive projects, IRR rankings may conflict with NPV rankings, leading to potentially incorrect decisions. It's important to understand how IRR compares to net present value. IRR produces a percentage return as its output, while NPV produces a dollar value added. IRR is best used for comparing projects of similar size and characteristics, whereas NPV is better for determining absolute profitability. IRR can have multiple solutions with unconventional cash flows, while NPV always produces a single, unambiguous answer. For these reasons, finance theory generally considers NPV to be theoretically superior to IRR, however. Both metrics are valuable and are often used together to provide a complete picture of an investment's attractiveness. Let's summarize the key points about internal rate of return. First, IRR is defined as the discount rate that makes the net present value equal to 0. Second, the decision rule states you should accept projects when the IRR exceeds your required rate of return. Third, while IRR properly accounts for the time value of money, it makes the assumption that cash flows are reinvested at the IRR rate, which may not be realistic. Finally, for the most comprehensive investment analysis, use IRR alongside net present value rather than relying on either metric alone. Together, these tools provide a robust framework for evaluating investment opportunities.
If you like this video, hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.